Hey guys, welcome back to the Retail Wage. So it's been some time since my last video and I've been just thinking of how to, actually make better content for you guys. So I think today is going to be something you guys like. So today we're going to talk about this phrase that probably every single retailer has heard of. Time in the markets is more important than timing the markets. But is this really true? Okay, let's start with the obvious, right? In this chart, you can see that yes, bull markets last much longer than the average bear market, and that's why time in the market is important. You want to stay invested. That's something that everyone talks about, everyone knows, and I don't disagree with it. But now let's look at some real interesting charts. So the first chart, something that you guys probably seen before as well, is everyone says if you miss the best days in the market, you're going to have poor returns. And of course that's true. If you look at this, if you miss the 25 best days in the S&P, you are as good as probably investing it in a treasury bond, right? So basically the red line is if you miss the best 25 days, and the black line is if you stay invested all the way. And now let's look at something more interesting. This is a chart if you miss the 25 best and 25 worst days. Now, this probably catch many by surprise, but you actually perform better than the market. So if you think about this, it actually makes sense because the worst days in the market is actually a bigger percentage than the best days. You often see on the worst days of, for example, COVID sell-off, you have 7-8% drops in a day, but even in the best days maybe you only get to see like 4-5%. And a lot of the times, the best days actually come after the worst days. So it's actually pretty reasonable for someone, if they decide not to stay invested during volatile periods, actually miss both the best and worst days. So, the conclusion is really time in the market is important. But, that's not exclusive with timing the market. You can actually do both, right? So you can have like a constant kind of DCA, which can refer to the last video of why DCA have been working for retail so far. But at the same time, a lot of people these days, they are looking at investing lump sum during dips. So in this video really is to tell you how to avoid those worst days. Worst days come in minus 6-7% days. If you even able to avoid 2 or 3 of them, that's going to be huge for investments over the long term. So here, basically timing the market is really not buying the bottom or selling the top. It's really about knowing, simple demand and supply. During huge shocks, will the market continue to fall or not, right? So to answer that question, we really need to look at the 2 biggest driver of the market during such times, and that is, if you recall, in my first video, I showed you guys the various market participants in the stock market. So we'll be really looking at the real money global asset managers, like your BlackRock, Fidelity, Bridgewater, etc., and the hedge funds, Citadel, Point72. So these guys actually react to market events, and they are big. That is why they actually drive the market during such times. Now, this is where it gets important. So how do we actually predict their behavior? So during these big shock events, we need to know that these institutions, they have strict risk limits. So they actually tend to sell first, ask questions later, right? You may ask, aren't these guys, like super sophisticated? Why are they panic selling? So 2 key reasons, right? One is they need time to trim their positions. Their positions are huge. So if, say, they want to sell, it's not like they can sell everything in a day, right? So they need to plan ahead, and they take days to sell, so they need to sell early. 2, they are actually, that's their career. So if they make the wrong decision, not only do they lose money for the funds, they're actually risking their whole job on the line. So imagine this, right? For example, this year, when Trump first announced the tariffs, and you're working as like a fund manager. And during this time, even if your gut feel is, oh, the tariffs are just, a temporary thing, the markets will eventually bounce back, because even if you knew, not know, but even if you were relatively certain that Trump may backtrack on his words, do you actually dare to say, oh, I'm going to hold on to all my positions and not sell anything? Because if the market continues going down, imagine the conversation between like you and your boss, right? You're going to be like, oh, your boss is going to be like, it's so obvious the risk is in the market, why didn't you sell? So in these scenarios, it just doesn't make sense, for the fund managers to take on so much risk, even if they don't think, the market sell-off is warranted. They will still sell because the risk is just too big. So knowing this, let me just show you two of these articles to show you that this is actually something that really do happen. So if you remember, last August, they had the massive, dollar yen unwinds, carry trade unwinds. So we could see that it actually caused, highly leveraged hedge funds, some of them to shut down, and they had to, unwind positions because they need to meet their internal targets. These funds have strict targets. They manage billions of dollars. They can't just like, oh, I'm going to take a bet that markets will rebound. They simply cannot, because the risk is just too big. They can't do it like retails like you and me. We can actually, go YOLO and then just stick to our positions if our risk tolerance is there. Funds simply do not have that risk tolerance. And then if you look at this quote, from this other portfolio manager, he basically says, we are really on hold because we only trade when we have high conviction levels. That is true for a lot of the big funds, right? If conviction levels are low, when, for example, tariffs hit earlier, there's a huge uncertainty. And during uncertainty, what is the best thing to do, right? The best, most justifiable and kind of, defendable thing to do during such times would be to trim some of your positions, would be to sell at least a portion of your stock holdings, for example. That is basically not only good risk management, but as well it's just a defendable thing to do, as a someone who's doing this as a career. So even if, the market rebounds, they can say, oh yeah, it's so uncertain, right? It's just prudent to sell a bit of the positions. But if they do not, the risk is much, much bigger, So let us now look at some charts to show you what am I actually mean. So first off, we have basically this. This is earlier this year during Liberation Day, where Trump announced the tariffs. You can see that the day he announced the tariffs, market dropped sharply, maybe about, I think, 3-4% if I remember correctly. And if you bought the dip here, what happened is the very next day, it dropped again, even bigger, I think by another 4-5%. So this is something that you as retail can easily avoid, because if you know the behaviors of the funds, you know that the selling will not simply stop in one day. Why? Because when these events happen, they have to sell a decent portion, of their holdings. And given the size of the holdings, the selling will not stop in a day, and they will not stop selling just because, oh, the stock is down 5%, let me hold on. That's not how it works, because they need to hit and stay within, for example, the risk limits. So they will not stop until they finish selling, and that, will take definitely more than a day. How many days? No one will know for certain, but at least, you get to avoid one big red day, right? Basically one of those worst days we mentioned earlier. And that can save you 6-7% easily in a scenario. So let us look at another classic scenario, okay? So let's switch to this. Okay. So do you guys know what is this? This is during COVID, right? Feels very long ago. So during COVID, the drop lasted even longer. If you look, this was when, kind of panic first started. People started to sell. And then if you apply what we mentioned just now, you know that institutions have to sell a good portion during this time. Would you be buying, would you be buying here? Would you be buying in this, 1-2 days? You wouldn't, and you definitely shouldn't, right? Again, if you want to say, oh, you are not sure where's the bottom, that's totally understandable. And then, you could start buying like here. But all I'm saying is it's perfectly avoidable in these big sell-offs to not buy here. And this will easily save you 7, even 10%. You don't have to be buying here because, of course, nobody can predict when it will turn. But reasonably, you can buy somewhere here easily. And that already would have saved you a lot, right? So now the next question, you're probably going to ask me is, how do you really, identify these opportunities and separate them from those small drops? Sometimes maybe there's a hot CPI print, maybe a Fed announces something that causes the market to have 1 or 2 rate days. How do you separate these big events? So I think the easy thing for us retailers to do, firstly, is to ask ourselves, is it a huge negative shock that is completely, unexpected? So again, going back to the example, the degree of COVID was not expected. We all knew that suddenly, things were going bad, she was hitting the fan, it was not going well, and then you know that no one saw it coming. Again, earlier this year, Liberation Day, no one expected Trump to come up with those steep blanket tariffs that he actually came up with. So right away, you will know that in the media and everything, you will know that it's very, very huge and unexpected news. So next, market price action don't lie, right? So news sometimes can be sensationalized, but look at the market price action prior and after. If it was trading calm prior and after this event, the market has, I would say, a bigger than 3% fall, a big fall. You should know that this is a major event that will cause funds to trim risk. So you may think 3% is not that big, but if you look at in the context of S&P 500, it is big. In the past 25 years, there's only a total of 45 such occurrences, and that means, roughly a 1.8 occurrence a year. So that is rare, right? So if you look at this, once you actually have a minus 3% coupled with this negative shock news, that's when you need to first start to be alert. And next, I also just show you 2 other things you can look at to be even more certain, right? So one thing you can look at is this. So let me switch back. Yes. So this is something on TradingView. You guys can look at if you are using other kind of charts, or basically you can just search for the number of S&P 500 stocks that's trading above the 20-day moving average. So 20-day moving average just simply is an indicator that says, how many stocks are trading strong. It's just an indication of momentum. So basically, the lower the number of stocks that's trading strong, right? So if you look at this during times of high stress, times like this April, there's only 3 to 4 stocks that's actually trading above its 20-day average, and that is very, very low. And if you look at, let's go to, again, this is COVID, yes, March 2020. Again, we were trading below 5 for a very long period of time, like maybe 2 weeks before the market bounced. So again, if you want to know when we are in such a condition, just look out for this indicator and wait for it to at least go below 10 before you start buying. So this was basically, if you look at here, the first day of the Liberation Day sell-off, we were still at 30. So using this, as well as the knowledge that funds will not stop selling, right, until there is certainty, you know with a very, very high certainty that the market is going to continue selling off the next day. And it did. And then we got, eventually we got below 10, below 5, and that is where you can start buying, right? So another thing I really want to highlight is because of how, funds need to sell, they don't really care, about supports, about resistances. So very clearly, you can see that during COVID, for those of you who like to look at, moving averages, 50, 100, 20, 200-day moving averages of S&P 500. Usually these are, kind of strong support levels that people look at. But during such events, institutions simply will not care, because they will not be like, oh, we are approaching support, let us hold back our selling. That's not how it works. When it comes to, facing potential career risk, when it comes to potentially losing like 10% on hundreds and billions of dollars, they have to get their exposure to where they are comfortable with and where they are comfortable explaining to their investors should the market continue to fall. So you see, it easily broke through all of these support like it's nothing. So again, don't look for supports to buy on deep during these events. Just wait and not buy the first 1 or 2 days of these dips, and then you can start buying. You will save yourself, easily 6 to 10% of the gains and avoid the worst days. So I think that's all I have for this video. Hope you guys find it useful, and in future videos I think I will talk about stuff like how to not kind of sell too early. I mean, flip side on rallies, why do sometimes rallies keep going? That is something for another day. But if you guys like this video, find it useful, please do give this a like and subscribe to this channel so that you don't miss like future updates. Also, feel free to leave in the comments what you guys like to see. Yep, with that, see you guys next time.